Welcome to The Explainer. Today we are tackling a really tough question, one that gets to the heart of the market. Why do so many traders, the vast majority in fact, end up losing money? We're going to dig into the behavioral science and the hard data to find out.
So let's just kick things off with a pretty shocking number. 80%. According to a study that TradesED cited, a staggering 80% of all day traders are done. They quit within the first 2 years. I mean, think about that. That's a huge failure rate for any profession.
So that number, it really makes you wonder, right? What separates that small group who actually make it? Is it just pure luck? Do they have some kind of secret strategy? Or is there something fundamentally different in how they think that the rest of us are just missing?
Okay, so to figure that out, we've got to look at the core problem. What is it that makes being consistently profitable so dang hard? Well, it turns out the answer isn't new. The clues have been hiding in plain sight for decades.
You know, the legendary investor Bernard Baruch was talking about this almost 100 years ago. His point was, look, success isn't about having a crystal ball and being right on every single trade. It's all about how you handle the times you're wrong. The real secret isn't predicting the future. It's about controlling your mistakes. And that right there, that brings us to the real heart of the problem. See, the biggest thing holding most traders back isn't some complex market theory they don't know. No, it's actually a deep-seated psychological glitch that's quietly wrecking their decisions. It's got a name, actually. It's called the disposition effect. Researchers came up with the term back in 1985, and it describes this totally irrational thing we humans do. We can't wait to sell our winners, but we'll cling to our losers for dear life. It is the exact polar opposite of what you should be doing. So what you're seeing here is this epic battle, right? It's our gut instincts versus a cold, rational strategy. Our brains are wired for survival, avoid pain, grab pleasure. And that works great if you're, running from a tiger. But in the markets, it's an absolute recipe for disaster. And hey, this isn't just some abstract theory. There is hard data to back it up. A landmark study back in 1998 by Terence O'Dean dug into 10,000 brokerage accounts. And what he found was crystal clear. Investors were selling their winning stocks way more often than their losing ones. To put a number on it, they were almost 60% more likely to cash in on a winner than to just cut a loser loose. Wild, right? So if our own brains are basically trying to trick us, what's the fix? How do the pros get past this powerful bias? Well, it really all boils down to one single critical word. And that word is discipline. But listen, when we talk about discipline in trading, we're not talking about some vague personality trait. It's an active, real system. It means having a hard and fast rule that forces you to do the exact opposite of what your gut is screaming at you to do. Cut those losses short and let your winners run. The founder of Investors Business Daily, William O'Neill, he put it perfectly. And notice he uses the word courage. Why courage? Well, because taking a loss hurts. It's admitting you were wrong, and our brain hates that. The disposition effect, that's just our brain trying to avoid that pain, just hoping and praying a loser will magically come back to even so we don't have to face the music.
Okay, that's all well and good, but how can you tell if your new disciplined approach is actually paying off? I mean, is there a way to, mathematically prove you've got a real edge? Turns out, yes, there is.
We can measure it using a concept called positive expectancy, which was really popularized by a trading coach named Dr. Van K. Tharp. It's basically a simple formula that tells you if your system is going to make money in the long run. It just looks at your win rate and average win size versus your loss rate and average loss size. If the number you get at the end is positive, boom, you have a mathematical edge. And check this out. This is a perfect real-world example of a strategy that's just bleeding money. First, look at the win rate, just 10%. Ouch. But that's not even the real problem. The killer is that average loss, over $1,700. It's almost 5 times bigger than the average profit. This trader was doing the exact opposite of what they should have been doing, a textbook case of the disposition effect in action. Tharp even came up with this handy scorecard to, grade your trading system. If your expectancy score is positive, you've got an edge. Simple as that. And the higher that number, the stronger your edge is over the long haul. The goal isn't just to be in the green. It's to build a system that's good or excellent or, hey, maybe even a holy grail system. So all of this, it really brings us to a super important point. Getting good at trading isn't just about reading charts and crunching numbers. It's about mastering your own mind. It's about winning the inner game. Because the second real money is on the line, our brains can just flip into survival mode. All that rational, logical thinking, right out the window. And in its place, you get these emotional reactions. And that's exactly where the biggest, most costly mistakes happen.
You know, the psychology experts over at EveryTrader, they point to these three behaviors as being absolute consistency killers. First, you've got revenge trading. You take a loss and immediately try to win it back. Then there's FOMO, the fear of missing out, where you see something moving and just jump in late. And finally, strategy hopping, ditching your entire plan after just a few losses. You see the common thread here, right? Every single one is driven by raw emotion, not by a disciplined, tested plan.
And that really leaves us with one last question to chew on. Look, knowing the market, having a good strategy, that's all important, for sure. But all the evidence seems to point to one thing. The biggest, most unpredictable variable in your trading success, it isn't the market, it's you. So maybe the real key isn't buried in the charts. Maybe it's staring back at you in the mirror.